All right, let's talk about that insurance bill. You know the one. It just shows up, right? Every month or maybe every year. You pay it and you move on. But have you ever really stopped and just looked at that number and wondered why this amount? Well, today we are going to completely demystify that bill.
So, can you actually change it? Oh, absolutely. The answer to that second question is a huge yes. You have way more power to influence that number than you probably think. And by the time we're done here, you're going to know exactly how insurers figure it out and, more importantly, what levers you can pull to take back control. For most of us, that insurance premium feels like this fixed cost, this mystery bill that we just have to accept. The renewal notice comes in the mail, we might let out a little sigh if it went up, and then we just set it to auto pay. But let me tell you, treating it that way is leaving a lot of your hard-earned money on the table.
So let's do it. Let's crack the code. Insurance companies aren't just picking numbers out of a hat, not at all. There's a very specific science behind it, and honestly, just understanding that process is the very first step to becoming a much smarter consumer.
Okay, first things first, let's get the main definition down. Your premium. It's just the price you pay for a promise. That's it. It's not a deposit, you're not going to get it back. You're paying the insurance company to take on your financial risk for certain things, whether that's a fender bender, a house fire, or a big medical procedure.
Now, the fancy technical term for this whole price-setting process is underwriting. It sounds super complicated, but it all just boils down to probability. See, insurers have these statisticians called actuaries, and their entire job is to crunch massive amounts of data to predict how likely someone just like you is to file a claim. Your premium is a direct reflection of that statistical risk.
Maybe the simplest way to think about insurance is to just picture one giant pool of money. All of us, we pay our premiums into this big pool. Then when someone has a covered loss, a car wreck or a tree falls on their house, the money to pay for it comes right out of that collective pool. So your premium, that's just your required contribution to make sure that pool stays full. And the riskier the data says you are, well, the bigger your contribution has to be.
So what data are they actually looking at to decide how much you need to chip into the pool? Well, it definitely varies depending on the type of insurance, but the logic behind it is always the same. They are trying to predict the future by looking at data from the past.
When it comes to health insurance, it's mostly about your age and where you live, mainly because healthcare costs are so different from place to place. But your lifestyle choices, they play a huge role too. For instance, under the Affordable Care Act, insurers can charge tobacco users up to 50% more for the exact same plan. I mean, that is a massive difference, all driven by a single risk factor.
Now, with car insurance, things get even more personal. Your driving record is a no-brainer, of course. So is the kind of car you drive. A zippy sports car is going to cost more to insure than a family sedan. But here's the one that always surprises people. In most states, your credit score is a major factor. Why? Well, the insurer's data shows this really strong link between how people handle their money and how they handle risks behind the wheel. It's all about predicting behavior. And for homeowners insurance, it's not just about you. Your location is critical. I mean, living in a flood zone or an area prone to wildfires obviously bumps up your risk. But what's really fascinating is that insurers also look at the property's claim history. So if the person who owned the house before you filed a bunch of claims for, say, a leaky roof, the insurer sees that specific house as a higher risk, and your premium could be higher because of it, even if your own record is spotless. Okay, so that's how they come up with the number. Now, let's get to the most important parts. What can you actually do about it? Trust me, you have more levers of control than you think, so let's walk through them. The biggest lever you can pull, by far, is your deductible. Think of it like a seesaw. If you agree to take on more of the initial risk by paying more out of pocket when you make a claim, that's a higher deductible, then your premium goes down. It's an inverse relationship. But here's the crucial rule. Only choose a deductible that you know you could comfortably pay tomorrow, no questions asked. Don't risk a financial emergency just to save a few bucks a month. Beyond the deductible, here are 5 really powerful actions you can take right now. 1, you have to actively ask for discounts. Call your agent and ask about everything. Good student, safe driver, you name it. 2, shop around. Loyalty almost never pays off in the insurance world, so get competing quotes every single year. 3, bundle your policies, like putting your auto and home insurance together. 4, work on that credit score. And finally, 5, look at your coverage every year and make sure you're not still paying for something you don't even need anymore. This quote from an insurance advisor really nails it. Your premium is not set in stone. It's a number that you can and absolutely should influence. Seriously, one 10-minute phone call to ask about discounts could easily save you hundreds of dollars a year. That is an incredible return on your time.
Okay, let's wrap this up and lock in the most important takeaways. If you don't remember anything else from our chat today, please remember these points. So, to recap, first, your premium is just a reflection of your statistical risk. Second, you can lower that premium by raising your deductible, but only if you can truly afford it. Third, you have to be proactive. Discounts aren't automatic. You have to ask for them and you have to shop around every year. But above all else, remember the real goal here. It's not just about finding the rock bottom cheapest price. It's about getting the best possible coverage for your needs at a fair price.
So there you have it. Your insurance premium is not some fixed, unchangeable bill sent down from on high. It is a dynamic number. It's negotiable. And you have the power to influence it by managing your risk, your coverage, and your choices as a smart consumer. So the only real question left is, what's your first move going to be?